All right, what's up, Tycoon? Super excited for today's video. We are going to be taking a look at one of my favorite strategies, okay, and one that can really transform, your life, honestly, if you use it long term and even in the short term, right? Short term meaning like a year. You could see some really great opportunities if you use this strategy correctly. We're going to be looking at plays that have about an 88% or higher probability of success. All right, so that's the main thing. I've got it all right here. If you start off initially with $5,000, all right, the play that we looked at is going to be about $4,780 worth of collateral. Okay, meaning that's how much money you're going to need to put up. All right, you're going to collect $207 roughly in premium. That's a 4.33% return in 1 week, putting your account balance at 5,207. Okay. Now, this is going to be all before it's compounded, okay? But if you look, your monthly return, okay, would be 5,827, all right? And your annualized return would be 207.86%, right? Leaving you with a very nice $10,000, okay? So this is strategy is going to explain how you can turn 5,000 to $10,000 in 1 year, okay? Now, if you actually do compound interest, okay, we'll look at it. And after 1 year, okay, with the compound interest, meaning that you're putting those premiums that you're collecting, all right, you're going to use those to eventually buy more option contracts or sell more credit spreads and use it as more collateral, right? This strategy would be assuming that you just keep all of that cash, or maybe you put that cash in a separate account, right? I think that this could be a really effective strategy for a retirement account because you know your risk, right? You're gonna put you're gonna see what your collateral is, right? This is gonna be your max loss, 4,780. And you can do this with a small portion of your retirement account, or you can take a small amount and start to do this. All right. Now imagine using this strategy with $50,000, $100,000, right? We're looking at a strategy that's going to have an 88% chance of success or more. All right. So yeah, with compound interest after 1 year, it would be 14,000. Okay. If you did this for 5 years, that's $1 million, turning $5,000 into 1 million after 5 years. Okay. And again, if you were to do this in a retirement account after 20 years, this would be 27,000, almost $28 million. All right. So that's why I'm making this video. We're going to break down what I look for on the chart. Okay. We're going to go over a couple things such as the studies that I use. All right. Currently, I have the Bollinger Bands on. That's what these lines are right here that you guys are looking at. All right. And we have the relative strength index on. All right. This is the RSI. Now, with this strategy, we're going to be selling credit spreads. Okay. So there's many ways you can do it. All right. A lot of people like to sell put credit spreads on the SPY just because typically it's very bullish. All right. Historically, it's very bullish. But there are bear market cycles and there are pullbacks. Okay. So, you can really look to try to collect the best amount of premium using this strategy here. And it will kind of help improve that 88% win rate even more. All right. What you want to do is you want to look at selling, you want to look for a divergence first off in between the stock and the RSI. All right. Meaning, look at this initial divergence here. All right. Where we're creating these lower lows, right? We have a low, lower low, lower low. Okay. Look at our RSI. RSI is relatively flat right there. Okay. So we're seeing this downtrend and a relatively flat RSI. All right. That's news to us that we may see some bullishness in the future, right? So we want to come down here and we see that we're at the bottom of our Bollinger Bands, right? We move from the bottom Bollinger Band back up to the middle and towards the top. All right. And once you hit the top, you come back down towards the middle and then the bottom, right? That's the whole way of the Bollinger Bands. So you can look and see, all right, well, I'm going to sell some credit spreads down here, okay, and collect that premium because most likely we're going to be having a move towards the upside, towards this middle Bollinger Band. All right. And when you're at the top Bollinger Band, you can look to start selling, call credit spreads. Okay. Now, again, you can use either one. The strategy is going to work either way, with the probability of success, right? But we want to further increase those odds as best we can. All right. So that's the main thing we're going to be looking at is we're going to use the chart and use the Bollinger Bands and use the RSI to help us out and help us further inform us on our decisions. Okay. So let's go to where the money is being made. All right. We'll go to the trade tab. All right. And if you look at SPY, it typically has option contracts that expire every few days. All right. Meaning you can come in here and use this strategy every single week and sell something 6 days out, 7 days to expiration, 8 days. There's 5 trading days within a week. So you have to keep that in mind. All right. But for the sake of this video, we'll go to like 6 days out. Okay. And we'll come in here, and what you're going to do is you're going to right click. All right. So if you wanted to sell a put credit spread, the first thing that we should get into, okay, is actually going to be the layout. This is very important. All right. So this is what you're going to want to put on your layout. All right. You're going to want to customize it and put on implied volatility, the probability out the money. All right. Since we're selling credit spreads, this is essentially going to be our probability of success because we're looking for them to expire out of the money worthless. Okay. Volume, open interest, theta, vega, and delta. All right. So those are going to be the main things that I look at, and it helps me kind of quickly gauge what I want to do. All right. So we come here, and I want to be looking for a delta of 0.7 or 0.8. All right. Either on the call side or the put side. And if you look, those typically have a probability out of the money of about 90% or higher. Okay. Close to 92%. All right. So what that's telling us is that right now, if we were to sell the 395 puts, okay, that would have about a 91% chance of expiring worthless, meaning that we would be able to collect that immediate $43. Okay. But to do that, you would have to, either use a lot of margin or have a cash secured put, right? You'd have to have the cash for that to buy 100 shares. So what we're going to do instead is actually sell a credit spread. So what you would do on Thinkorswim is hit sell, go to vertical, okay? And I like to make these 5 wide, meaning the initial strike is going to be 395. Okay. And then I'm going to go down 5. All right. And put it to 390. All right. So that's the type of spread that I typically like to use for this strategy. All right. And you would come in here and hit confirm and send. You would see it would cost you your max loss, right? This is going to be the collateral used for this would be about $4,770. Okay. You would collect a credit of about $217. All right. Now you can come and do this on the call side as well. So I'll just show you got that as well. So I'd come over here and I'd look at my delta, and I'm looking for a 0.7, 0.08. I see a 0.7 right here. It's got a 93% probability of out of the money. I like that. We're going to go right click, hit sell, hit vertical. Okay. And we're going to make it 5 wide. So we're going to go 425 to 430. Okay. You would come in here, hit confirm and send. All right. And this one would be at 4,800 collateral. All right. With a credit of $187. All right. Now there's different ways to do this. Okay. You can have your own varying risk. You can actually collect a lot more premium, choosing further plays, a higher delta plays, right? If you look at a play with a 15 delta right here, okay, so let's look at how much premium we would collect selling a 15 delta. Okay, hit vertical, we'll make this 5 wide. Okay, and we come in here and we would be able to collect almost $500, okay, nearly $500 on a $4,500 credit, okay, or collateral. All right. So, you really can try to increase your profits, but it will, skew your probability of success. Okay. So, when you can already get these returns right here, okay, of, $207 in 1 week off of $4,780 collateral. Okay. And, essentially grow your money $200 a week, about $800 a month. That will end up netting you, okay, basically 100% on your initial return. All right. So that's the whole purpose of this video is, coming in here, look for a delta of 0.7, okay, either on the call side or the put side. All right. And another very important thing to note is going to be the implied volatility. Okay. So that's the percentage right here. When you look at the option contracts, okay, that's the percentage of volatility that we could move to the upside or to the downside. All right. and it's going to give you the actual dollar amount here, the number amount, it's 847. All right. So it's saying that SPY could go up $8 to the upside or $8 to the downside. Well, if we look right now to about 410, so if we were to come up $8, that would put us at 418. Okay. That's well below our 425 credit spread that we sold, right? Think about it on this side. If you come over to the put side, all right, where we sold a put spread, and we go ahead and take a look at how much that value is going to be, $8. So SPY is at 410 right now. Okay. If we were to come down $8, that would be 402. All right. So that's still within the expected move. We are well outside of that range. Okay. Being almost another $7 below that. Okay. So if you think about it that way and you understand, the strategy and what I'm telling you guys, you're putting yourself at some really, really great odds. Okay. And then if you combine that with the chart data, right? So again, you're going to be looking for these percentage plays. All right. And remember, I said you can collect more premium when the Bollinger Bands are at the top end, right? So when we looked at this credit spread, it wasn't as much as we were going to be able to collect on the call credit spread. All right. And, the reason being for that is because we're at the top end of the Bollinger Bands, right? So, when you combine the probability of out of the money, right, and looking at the delta, and then you use that with some of the chart data, some of the Bollinger Bands, okay, it will really just help further improve your odds. Looking for those divergences is the main thing that I love to look for, and the SPY is really good at respecting those, especially relative to the time frame. So if you see a small time frame divergence, you can expect it to have a smaller move on a much smaller time frame versus a larger move, right? If we notice that larger bullish divergence on the daily chart had a very nice move, okay, when we created these very lows here, but we could stayed relatively consistent here. We had that slight bullish divergence, okay? SPY went from 362 all the way up to about 390, okay? So really nice move there, 30-point move within a short period of time, and you would have been able to collect a lot of premium down here on these puts while everyone was panicking, expecting a move to the upside. All right. So thank you guys for watching the video. Hopefully this made some sense. If you found any value, please like and comment. All right. Don't forget to subscribe and let me know if you have any questions. If you want some more strategy videos like these, I do viewer requests every single week. All right.